Hi, everyone. Welcome to the Yes Investment Club. This is the fifth and final chapter of the Advanced Investing course. And this chapter will focus on alternative investments. So, what if I told you that stocks is just one of the many ways to invest, and there are six other ways that in which an educated investor can invest and earn more income? And these six ways are explained in this chapter by using the definitions and examples that we'll explain. So the syllabus for this chapter will be first we'll move to the derivatives, then futures and options, then commodity markets, then real estate, and then finally we'll end it with cryptocurrency.
So let's begin by talking about derivatives. So derivatives are a type of alternate investment that are fairly complex, but we'll go into the definition and a bit more explanation now. So derivatives, as a definition, is a financial contract that is agreed upon by two or more parties, and its values are based on an underlying asset. So a derivative is a sophisticated type of financial security that is agreed upon by two or more parties. It is sort of like a contract between the traders first and foremost. So they use derivatives to gain access to specific markets and trade various assets. These can include things like stocks, bonds, commodities, currencies, interest rates, and market indexes are the ones that are most commonly held assets for these derivatives. And the contract values that the derivatives are based on are determined by the changes in price of the held assets that the derivative is based on. So the way that derivatives are used is that derivatives can be used to hedge a position, speculate on the performance of a held asset, or to give holdings a certain amount of leverage. These assets are typically traded on exchanges or over-the-counter (OTC) and are purchased through brokerages. Futures and options are commonly traded derivatives that are also there in today's markets, which we'll get into in the next topic.
Okay, so let's move on to futures and options. Like Ishan said, they're probably the most commonly traded derivatives in today's markets. And so first, let's try to understand what exactly a future is, because it's quite a sophisticated concept. So just simply put, futures are financial derivative contracts that bind two or more parties to trade an asset at a predetermined future date and price. This is the most important characteristics of futures to keep in mind. And another thing you have to keep in mind is that at the end date of the futures contract, the buyer or the seller must buy or sell the asset at the price that they agreed to, regardless of the current market price. So just to understand futures better, the best way to put this is through an example. So let's assume a trader wants to speculate on the price of Indian government bonds by purchasing a futures contract in May with the expectation that the price will rise by the end of the year. So he's basically betting that the value of the government bonds will increase by December. So the December Indian government bond contract is currently trading at rupees 50. So the contract's value itself is at 50 rupees. And let's assume that the current price of the futures contract in May is 48 rupees. So what the trader does is that he locks in the December contract for the Indian government bonds at 100 bonds. So that means he basically acquires 5,000 rupees of worth of Indian government bonds through the contract, because you're buying 100 Indian government bonds, each at rupees 50. So 50 into 100 is 5,000 rupees. So initially, the trader will only have to pay a fraction of that amount upfront. And so that's considered the initial deposit with the broker who's taking care of the contract itself. It's just a way of showing trust to the broker that, oh, at the end of this contract, I will definitely buy or sell the stock. And so the price of the bond, let's assume it fluctuates a lot from May to December. And so does the value of the contract itself. And so if the bond price becomes too volatile, the broker may request additional funds. So this is just you could say it's like a safeguard, because if the bond price drops a lot, the broker may choose to ask for more funds just to ensure that at the end, the contract is respected by the trader. And this is just another way to put in trust with the broker. So now let's fast forward a little bit and go towards the contract's expiration date, which we are assuming is on the last Sunday of December. During this time, the price of the individual bond, the Indian government bond, has risen to 65 rupees. And the trader basically wants to exit the position by selling off the original contract. And so due to the fact that the bond's price is increased, the difference is settled in cash and the investor earns 1,500 rupees in profit. So that's excluding any kind of broker fees or commissions. So you might think, how has he earned 1,500 rupees? Well, you see, originally the bond prices were at 50 for the futures contract when he first started the contract itself. But now they've risen to 65 rupees per bond. And so what's happened is, if you minus the difference between the original bond price and the current bond price, you will get 15 rupees, which is the difference between the two prices, into the 100 bonds that the trader originally bought, which gives you 1,500 rupees in profit. But let's assume that instead of the price increasing to 65 rupees, the bond price had dropped to 40 rupees. And so what would have happened is the investor would have lost 100 rupees, because what's happened here is essentially that 50 minus 40, so 50 being the original price of the bond, has fallen now to rupees 40 per bond. And so since there's that 10 rupee difference, if you do 10 into 100, which is the original amount of the bonds that the investor wanted, it results in negative 1,000 rupees, which means the investor has made a loss of rupees 1,000. In a similar manner, there's actually another kind of option called called options. And it's another type of financial instrument that's based on the value of financial securities, such as stocks. And this is mainly what you call an option. Let's not get a bit confused with what is having a stock option and what is option as a financial instrument as well. Those are two entirely different things. So there's one major difference between futures and options, which is that the holder of an options contract has the option to buy or sell the held asset depending on the type of contract they hold. But in contrast to futures, they are not obligated to buy or sell the asset. So what this basically means is, if we see in the futures contract example that we gave, the investor at the end of the contract's expiration date had to buy or sell his contract regardless of how much the price was. So no matter what, he was legally bound in buying or selling the contract that he acquired. But here in options, it's not required that an investor has to do so. Each contract will basically specify an expiration date by which the option holder must exercise their right to choose, which is that they want to go ahead with the contract or don't want to go ahead with the contract. And so the agreed upon price in an options contract is referred to as the strike price. There's no special reason for this in particular. It's just that it's the price where the investor determines whether they truly want to acquire the contract or not. Because what's happening here is, let's take the previous example. If they find out that the price of Indian government bonds has fallen, they may choose to not go ahead with the contract. And if they think it's actually risen in price, which happened actually, then they may choose to go ahead with the price. So that's the reason why options are referred to as options, because it literally allows you to choose whether you want the contract to be binding or non-binding to you.
Great. So one small note, these futures and options market is actually betting your investment value on the predicted future value, right? So as the name suggests, futures and options, you're actually betting your stock prices or something on the future performance of that underlying asset. That's it. So we can move on to commodity market. So a commodity market is essentially a marketplace for buying, selling, or trading raw materials or primary products. And the commodity market can be split into two broad categories, which is hard and soft commodities. So a hard commodity includes natural resources such as that are mined or extracted, such as like gold, rubber, oil, those kind of things. And a soft commodity are agricultural products or livestock, such as like corn, wheat, coffee, sugar, soybeans, and pork, right? So these commodity markets are actually not traded by us like investors. They are professional traders who enter this kind of market only to trade in these commodities. And as investors, you can invest by gaining exposure to these commodities, like by investing in companies that have these commodities as their product. And you can invest in future contracts or options which are related to these commodities, right? So, for example, if considering the Ukraine and Russia crisis, if you think the oil prices will tank down, right? So you can just go onto the futures and first sell the future and then buy it later on, right? So you're actually playing in the commodity market, but using the concept of derivatives and futures to make the profit.
Right, so now we'll be moving on to real estate, which is again another type of alternative investment. And so real estate includes the land as well as any permanent improvements to the land, whether natural or man-made, such as roads, buildings, homes, and even trees. And so real estate is a type of real property, and by real property we mean that any land that comes with attached properties, house, facilities, etc. And personal property, on the other hand, is anything that is not permanently attached to land, such as vehicles, furniture, and equipment. And so real estate can be classified into 5 main types. So residential, commercial, industrial, raw land, and special use. And so first, residential. And so residential real estate refers to any property that is used for residential purposes. So things like single family homes, condos, cooperatives, duplexes, townhouses, and multi-family residences with fewer than 5 individual units are some of the examples of residential real estate. And next we have commercial real estate, which includes apartment complexes, gas stations, grocery stores, hospitals, hotels, offices, parking facilities, restaurants, shopping centers, stores, and theaters. So they're all examples of commercial real estate. And commercial real estate is usually used to refer to those areas where business is carried out, and that's why it encompasses so many different types of real estate. And the next we have is industrial real estate. And this refers to any type of property that is used for manufacturing, production, distribution, storage, or research and development. And so all those are considered as industrial real estate. And so things like factories, power plants, and warehouses can be some of the examples of industrial real estate. The next we have is raw land, and as the name suggests, it's literally raw land. So undeveloped property, so vacant land and agricultural land like this one are all examples of raw land. So things like farms, orchards, ranches, and like timberland, they're all raw land real estates. And the last we have is special use real estate. And so those refer to the properties that are used for like a very specific purpose. So for example, like a government building or libraries or parks or places of worship like churches and stuff, and schools as well. So these are the different types of real estate.
Just to add on, real estate can be used for 2 types. First is personal wealth and second is investment. So the personal wealth criteria is actually when you have additional deposited money and you want to invest in certain properties, you just invest in like residential. For businesses, they invest in more offices, right? And that's creating personal wealth because each real estate is considered as an appreciative asset, wherein the value increases over time because because of the development of other properties on the sides, or there is an increase in the real estate price itself, right? So for personal wealth, it is used. Second is investment, because specifically speaking, for like companies, if they want to take loan, the loan is based on something that you give, right? So people tend to mortgage their residential or commercial properties in against to taking the loan, and that's why it is considered as an investment aspect, right? And majority of the people, instead of going to the stock market or wrapping their heads around the futures and options and derivatives, they simply invest in real estate because it is a simple investment method to earn more profit over time.
All right, now let's move on to cryptocurrency. It's probably the most recently developed alternative form of investment. And so you could say it's kind of still unproven because it's only emerged in the past 10 years or so. And a lot of the market is still volatile. Although we wouldn't stop most of our followers from investing in it, just keep in mind that cryptocurrency in itself, it's still very unproven. World governments are still yet to accept it as a legitimate form of currency as well. That's one thing to keep in mind if you plan to invest in cryptocurrency as well. So first, let's begin by actually defining what is cryptocurrency in itself, because a lot of people are very confused by what it means. So in its simplest words, a cryptocurrency is a type of decentralized digital money that is protected by cryptography and is based on blockchain technology. So if you see that there are a few keywords that we need to explain in order to truly understand how crypto works. So let's talk about blockchain first and foremost. So in the context of cryptocurrency, blockchain is essentially a digital ledger. If you don't know what a ledger is, it's just a book of accounts or a book of transactions that keeps track of who's giving money to who or who's giving a different thing to who. So this is actually a digital ledger that keeps track of every single transaction involving variety of assets such as money, real estate, and sometimes even intellectual property. In crypto, it basically keeps track of the transactions between different users. And so what happens here is the users essentially share access in cryptocurrency, and any information that is put on the digital ledger is transparent, it's immediate, but one thing to keep in mind is that it's immutable. In this case, what it means is that anything recorded on the blockchain is permanent, and it basically cannot be edited or tampered with in any way, shape, or form. So essentially what happens is the moment your transaction is listed on the blockchain, it cannot be removed from it. It is stored on the blockchain's history. And this only goes to prove whether you are dealing in legitimate transactions with other users of cryptocurrency. And it's just used to show, instead of a way of using banks, it's just a way to show reliability of the crypto itself. Now let's move on to the second term that we saw in the definition, which is decentralization. So first, let's talk about centralized money. Centralized money essentially refers to any kind of regular money or currency that you see outside in the real world. And this money is typically governed by authorities such as the Reserve Bank of India. So in the case of India, it's the RBI, who print the money, who give value to the money, who defines where you can use it, how you can use it. But cryptocurrency is considered decentralized because there's no such supervisory body who's basically overseeing all the transactions. It hedges everything on the users themselves, primarily because the blockchain ledger, what it does, it stores all user data about transactions, and that since it cannot be edited, that ledger itself can be taken as absolute. And so basically the thing with cryptocurrency is there is no similar authority that can be held accountable for supervising the distribution of a specific cryptocurrency. The closest thing that comes to this is a cryptocurrency exchange, which works in a very similar manner to a stock exchange that we've covered previously. So you might have heard of apps such as Binance and Coinbase, both of which are major cryptocurrency exchanges, but they don't act as banks in like a transaction. Because if you see a normal transaction, typically what happens is you purchase a good, and in order to swipe your card, the bank takes out a certain fee, and on top of that, you have to approve the transaction sometimes so. And so the difference here is if you're dealing with cryptocurrency, none of that is required. You don't need the bank to approve your transaction. Your crypto is automatically taken out of your wallet and given to the other user. And in exchange, what happens is it's stored on the blockchain ledger. So that's one thing to keep in mind. And these exchanges only serve like that. They simply serve to match buyer and seller in the same way that the stock market does. It only serves as an intermediary for them.
And that brings a wrap to the advanced investing course. Thank you so much.